Good morning and welcome to this Monday, April 12th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're about to kick off another week. This is a pretty big week. Earnings season kicks in on Wednesday when we get JP Morgan, Wells Fargo, Goldman Sachs, among others, that'll be reporting their latest results. And I'll tell you what, we're going to have some blowout numbers in the financials. There's no doubt in my mind. I think when you look at what's happened with the 10-year Treasury yield, you look at what's happened with the financial stocks and how they've outperformed over the past few months. Wall Street has been accumulating that area, and that's for good reason. There are going to be some really strong reports. So don't be shocked with some of the numbers you see coming out. Of course, strong earnings doesn't always mean strong reactions because a lot of times it's already built into the price. So that's part of the risk of holding into earnings reports is that you get exactly what you expect, and yet the market goes down and you're left scratching your head wondering why stocks are not rising. And unfortunately, those who don't follow the stock market don't really realize that buy on rumor, sell on news, that old Wall Street adage, and it's so true, especially with earnings season. So I do think the earnings are going to be strong. I think these stocks, many of them will go higher. I think the overall market's going to go higher. But will they lead after the earnings come out? That's a little bit more difficult to say. Fed Chief Jay Powell, talking over the weekend, talked about substantial improvement in the economy and how things are really picking up, but also said that he sees no interest rate hikes. Very, very unlikely that the Fed will hike interest rates anytime during this year. So part of what's going on here is you've got a lot of money that's, well, I won't say money coming in, but technically you've got the Fed who's backing some very accommodative policies for the market. So you've got a lot of fiscal support. You've got monetary support based on the vaccines. You've got folks wanting to get out. They've been saving for the last 14 months or so, going nowhere. And now everybody wants to get out. And so the economy is really going to be strong. And as a result, we have seen some of the rates pick up. I think the biggest reason is just you've got a lot of investors, professional investors, portfolio managers and so forth that are seeing that it doesn't make a whole lot of sense to be holding these bonds that are paying almost nothing when you see the stock market continuing to go up. So we're getting that rotation. Anyhow, I suspect we're going to see prices continue to go up. And the real challenge, like I've said for the past 6 months, is not whether the stock market goes higher, it's what leads. And that's going to be the key. I think you can probably throw a dart and pick stocks over the next 6 to 12 months and probably go higher. But the question is, can you go higher or can you outperform the S&P 500? I think that's going to be the bigger question. But let's go ahead and get things going here. So over at Earnings Beats, if you are new to Earnings Beats, maybe this is your first show, welcome. Appreciate all the support everyone gives us here at Earnings Beats. Happy to do this. I really enjoy looking at the market, talking about the market. It's been a challenging last 12 months, 13, 14 months, whatever, throughout the pandemic. But there have been many signs pointing to higher prices that I've talked about for the last 12, 13, 14 months. And it continues to be in play today. I was looking at some of my big picture kind of charts, looking at transports versus utilities and consumer discretionary versus consumer staples and small caps. And you just kind of go on and look, growth rebounding versus value, but everything going up. And I honestly don't see anything on the horizon that looks bad to me. You got the Volatility Index, which is kind of a fear meter. It's always good for the market to be a little fearful. What you don't want is everybody to think that the market can't go down. We get the VIX down to 11, 10, then you got to start worrying a little bit more about complacency. But as long as that VIX is elevated, which it has been, everyone that was over the last year that keeps calling for the stock market to go down, there's already a lot of fear out there. So there's a lot of money sitting on the sidelines. The market's not going to go down while there's money sitting on the sidelines. The market's going to go down when we run out of buyers, when we run out of money. And that's probably a long ways off. But anyway, the volatility index, which has been up in the 20s and 30s and even all the way up to 85, 90, whatever it was back in March of last year, it's been showing a lot of fear. And ever since we topped on the VIX back in March of last year, the stock market has continued to go up as fear levels come down. Well, I think it was probably maybe 6 weeks ago, I wrote on an article in my blog saying that the VIX went below 20. And when the VIX historically goes below 20, that tells us that the stock market's likely to go higher. And I said that was going to be one of the catalysts likely to drive the S&P through 4,000, which now we're at over 4,100 and continuing to move. So anyhow, I think there's a lot of real positives out there, and I just don't see, outside of just being overbought in the near term and having normal pullbacks from time to time, profit taking, I just don't see problems in the market. I think perhaps over the summer, which typically is a slow period, I think we may run into some more problems, more sideways action, maybe, inflation. We got inflation reports coming up, by the way. I think one comes out tomorrow, if I'm not mistaken. And sometimes you're going to get reports that are going to stoke a little fear. So you'll see the VIX jump back up to 20, maybe even 25. And as a result, we see the pullback. It's going to be a buying opportunity, in my opinion. All right, over at Earnings Beats, just want to point out, if you are new to Earnings Beats, we have a free Earnings Beats Digest newsletter. Just simply type in your name, email address, hit that subscribe button. You can check out our portfolio performance. Yeah, this quarter definitely is weaker because we were much more focused on the growth stocks going into this quarter. The one portfolio where we focused a little bit more on the value names, you can see the income portfolio outperforming this quarter. But I'd like to outperform every quarter, but honestly, who outperforms every quarter? I don't know anyone who has outperformed every quarter. Most portfolio managers don't outperform for a year, much less doing it every quarter. So we were bound to have some hiccups and weakness along the way. I think that's kind of what's going on here this quarter. But if you look at our since inception returns, all of our portfolios well ahead of the S&P 500. It's not even close. And the ETF portfolio, this is the one that we started about 6 months ago, and it's kind of interesting. I think coming into a new portfolio during a pandemic has been a little bit difficult, especially with the ETFs and as money was rotating and so forth. But I still am very bullish on being able to outperform using ETFs, outperform the S&P 500, that is. So this quarter, like the portfolios with our stocks, the ETF portfolio struggling this quarter against the S&P 500 because, again, it was more growth oriented. Since inception, we're slightly below the S&P 500. I only mention all of this because next Monday we have our next draft for the ETFs. And when I say draft, we pick the portfolios, the ETFs that go into our portfolio, our ETF portfolio. Stock portfolios will be done next month in May. But the ETF portfolio, which was done back in January 19th, April 19th is when we switch this one out. So every 90 days we do this. And later today, we're going to have a sneak preview of how we look at this. And I'm going to show you a little bit, I'll give you a small glimpse of some of what we'll be talking about later this afternoon. But this afternoon's event is free. It's free to everybody. I think if you're going to invest in ETFs, you really need to understand a better way to invest. And it may not be our way. You may not like some of the things we do, which is fine. But we do have what we call our Etf Analyzer, a spreadsheet, which I think is really cool in putting together ETFs to really understand what it is that you've invested in, rather than just say, oh, I want this ETF, I want that ETF. Take a look at it after you put together what you think is a great portfolio and see if it truly does meet what you're trying to do in the market. So anyway, I'll talk about that in just a minute. Let's move on to what happened on Friday. We saw the Dow Jones Industrial Average rise another 300 points, a new record, 33,800. I remember when we went through 33,000, I said probably wouldn't be long before we hit 34,000. Well, we're almost there. And I have a feeling as earnings season kicks into gear, we're going to be above 34,000. S&P 500 took a while, got through 4,000. Didn't take long to get through 4,100. They're now up at 4,128, gained another 31 points on Friday. Nasdaq bouncing back. The last week, maybe even 10 days or so, You can see big move up. We were down below 13,000. Now we're threatening 14,000. Huge move in Nasdaq recently. Mid caps up about 0.5% on Friday. Small caps up a little less. These two groups, especially small caps, money's been rotating away from this group. But the overall trend remains higher. And this is key for a secular bull market. Secular bull markets, one of the hallmarks is that just about everything goes up. Everything can't lead at the same time on a relative basis, but everything can, for the most part, go up. But you go through periods where money, for whatever reason, rotates out of certain areas and into other areas. I mean, we saw the Nasdaq leading throughout the pandemic, really until September, and then even a little bit more later in the year. But once January hit and we started seeing some selling, well, in January, February, March, you can see the S&P and the Dow both went up, breaking out to new highs, while the Nasdaq went down. It's a rotation. In a bear market, when money leaves the Nasdaq, it doesn't go into the Dow or the S&P, it just leaves the market. And so that's one of the ways that you can kind of evaluate the overall sustainability of a bull market is, do you have wide participation? When some groups are pulling back, or other groups breaking out to carry the load? And that's exactly what we've been seeing. And it won't be long before the Nasdaq breaks out again, and we'll probably see pullback in the S&P and the Dow. I think that will probably coincide with, as we go through this earnings season. I wouldn't be surprised. Leading us on Friday in terms of sectors, healthcare. We don't see healthcare up on top very often, but this is a group that has been strengthening over the last month or so, as you can see. It was up more than 1% on Friday, still trying to get up through the high that was established back in January. Industrial is also strong. This group's been strong for quite a while. Technology, look at this, making the breakout above that February high. And that's why I don't think it'll be long before we see the Nasdaq breaking out. Energy, weak, rotation. It's what I keep preaching during secular bull market advances. Energy, couldn't get enough of it from the beginning of February through the first half of March. And that was the group that was leading. Everybody was really high on energy. I'm high on it. I'm just not as high on energy as I am on some other areas in the market. But energy over the last 4 weeks, 3 to 4 weeks, you can see pulling back. And now that it's pulling back, you've got other areas like technology, like industrials, like healthcare moving to the upside. One industrial area, or one industry group, I should say, not an industrial, it's a consumer discretionary area. You've got clothing and accessories making a very significant breakout. And I'm going to talk about this a lot more in just a few minutes as well. 10-year Treasury yield, not any economic news due out this morning, but again, Sunday evening, Fed Chief Jay Powell said that the economic outlook is substantially brighter based on vaccines, fiscal and monetary support. And money has been rotating out of bonds. That's typical when you expect economic activity to improve, to strengthen. And so this is, I like to watch what's going on in the bond market for a couple of reasons. First of all, I've said this many times before, I haven't said it in a while, but I think the bond market tends to be smarter than the stock market. I think the bond market tends to get things right. And so when you're seeing selling in the bond market, which is what drives yields higher, that's telling you that bond investors see a strengthening economy. In a strengthening economy, you don't want to be holding on to bonds. You've got a fixed level of income, and as earnings expand, economic growth occurs, and earnings expand, multiples expand, the stock market goes up really fast. The bond market, you just sit there with your same yield. So that's why we're seeing this money rotate and why we're seeing yields move higher. I think that continues. I don't believe interest rates are a problem at all. As I've said for the past couple of months, I think, media needs something to write about. They need something to be fearful about, because fear is what drives folks in to read their articles. And this was the latest fear mongering tactic. It's higher interest rates. Look at a long-term 50-year chart on the 10-year Treasury yield. I mean, I can show you. Let's just pull up the month of this 15 years, but I'm going to go back 40 years. Now, I want you just to keep things in perspective where we are right now. 1.67% on the 10-year Treasury yield. Look at where interest rates have been. should we really be worried about interest rates at 1.67%? I mean, honestly, all we did is get back what we lost during the pandemic. I mean, the yield, everybody was pouring into bonds. It was one of the biggest bubbles, if not the biggest bubble in terms of an asset class anywhere. And everybody poured into bonds and yields dropped down to historic lows. All we've done is kind of gotten back to where we were. We're still in this 40-year downtrend in 10-year treasury yield. Interest rates are historically low. And except for the pandemic, we really have never seen rates this low. And yet somehow I'm supposed to be worried that higher interest rates are going to throttle the stock market. And by the way, GDP's, the Fed's already come out and said 6.5%. I think it'll be higher than that. I think it could be 7-8%, maybe even higher than that, with historically low interest rates. I can only tell you from my perspective, if you're not familiar, if you haven't followed me, haven't listened to me, I was in public accounting for 20 years. I valued companies. I was a principal in one of the largest CPA firms in the Washington, D.C. area. I've done valuations. When earnings are expanding as rapidly as they are expanding now and continue to expect to expand in a historically low interest rate environment, these earnings are incredibly valuable. And that's why the stock market keeps going up and people scratching their heads saying, we're in a pandemic. Wow, why is the stock market going up? Well, we've got a lot of pent-up demand. We're going to have tremendous economic growth ahead, and interest rates, when you value future earnings, you discount those future earnings using current interest rates. Current interest rates, even though we've gone up, still incredibly low. So the case for higher equity prices, in my opinion, has never been stronger. Never. And now you've got the Fed coming out and saying, we're not raising rates this year. They're on record saying they don't anticipate raising rates until 2023. If rates stay low with this kind of growth, valuations are low right now. They're not high, but we'll see what happens. I mean, I've been preaching this throughout the pandemic, and I know a year ago, folks probably thought I was crazy, but I see the market going a lot higher. And I'm not talking about for the next 3 months or 6 months. I'm talking about for the next decade. We'll have pullbacks. We'll have cyclical bear markets along the way. We may have 2 or 3 of them over the next decade where we drop 20%, and that'll scare everybody. And once again, it'll be the Great Depression talk. But over the course of the next 10 years, and I think a lot of it's going to be fueled by money simply pouring out of the bond market, continuing to pour out of the bond market. We won't be in a problem, in my opinion, until the 10-year treasury yield probably reaches 5-6%. When we get up to that level, because then you start having choices. Now, portfolio managers look in the same way. I can get 5 or 6%. Do I want to risk my money in stocks? And that's how this rotation works over long periods. So I think we go higher. Anyway, spending a lot of time on that. All right, so later today, we've got this sneak preview of the Etf portfolio and how we design it, the strategies we use, and so forth. And I just want to give you like a brief, a sneak preview of the sneak preview, if you will. Here's an ETF. This is the Ishares US Aerospace and Defense ETF. Now you can see here on the chart, this is an ETF that's looking really strong. I think that looks good. Now it invests obviously in aerospace and defense stocks. So if you're going to invest in this, probably the first thing you ought to do is look at those 2 charts, aerospace and defense. Now I look at it on a relative basis. I want to see what the groups are doing relative to the S&P 500. Now defense had been on a tremendous move to the downside, been serious, significant underperformer, but it has started to strengthen in 2021. You can see the PPO, which is still negative, is definitely strengthening, or it's weakening less, if that makes any sense. When you're in negative territory, I don't really look at momentum strengthening until you get above 0. Here, what this is telling me is that the horrible selling momentum is slowing. That's what the PPO rising beneath the center line means. Doesn't mean that you got great momentum. It just means that your relative momentum to the downside, which was horrendous, is slowing. And so now we're starting to make a relative move back to the upside, which is good, and getting above the 20-day. Now, looking at the actual absolute chart, you can see that defense just made a breakout over its June 2020 high. We're way above that number in terms of the S&P 500, and that's why we have seen the relative strength continue to deteriorate. But we're now making an absolute breakout, and that usually will coincide with relative strength. So I look at defense as not the best group out there, but certainly one that's improving. If we move over to aerospace, you can see maybe a little similar action here. I would say that the relative strength since November has been much stronger. You can see that the relative PPO has moved positive. We're in positive territory. So this, I'd say, looks better than defense, but they're both, in my opinion, strengthened. They've both been strengthening. On an absolute basis, you can see aerospace trending higher, continuing to put in higher highs, higher lows, but neither aerospace or defense have moved back to February highs. So, if you're looking at how groups have performed since the pandemic started, you would look at aerospace and defense and say, not interested. But if you're looking at just simply what's been happening over the past 3 to 6 months, then I think you'd probably look at these groups and say, hey, this is a group I want to maybe take a shot with. Now, I'm going to go back here to the ITA for a second, and I'm going to show you our spreadsheet in just a minute that we use, our Etf Analyzer Spreadsheet, because that summarizes, it does a lot of research for you and summarizes things that literally will take you a couple minutes to research rather than several hours maybe. Maybe more than that, because we do it with a lot of ETFs. But the ITA, if you look at the top 10 holdings, first of all, you'll know that 72% of this ETF is represented by 10 stocks. That's pretty heavily concentrated in 10 stocks. And I can tell you that 2 stocks represent 37% of this ETF. So sometimes you get into an ETF and you just think, all right, I'm diversified. I'm into a bunch of aerospace and defense stocks. That's great. If you don't do your research and you're just looking at the title of the ETF, you honestly don't know what you own. You think you know what you own, but you don't know unless you do your research. So 2 stocks represent 37% of this. So you better like these 2 stocks, and they better go higher, or your ETF's going to struggle. The first of those is Boeing. So Boeing, honestly, looks pretty good on the chart, been trending higher. We got up here to $230, got here to $240. When we pulled back, we held 230, 240. The 50-day moving average is just above 230. I think as long as Boeing stays above 230, I'm okay with the stock. Do I think it's the best stock out there? No, I don't. I mean, Boeing's at 250. Back in December, it was 240. We've seen a lot of stocks doing a lot better than that since the vaccine news came out. That was actually here back in November. So Boeing looks good. It's not one of my favorite stocks in the market, but it looks good. The other stock, both of these stocks, by the way, are 18% or more of the ITA, that ETF, Aerospace and Defense ETF. So now you got Raytheon. Raytheon, yeah, it's been strengthening, looks pretty good. You can see the top here around 75, top here around 73. Made a breakout, came back down, hit that 20-day, broke out again, pulled back 75, 50-day moving average 75. So I think that when you're looking at Boeing, I'm going to say 230 is the level to watch there. Raytheon, I would say maybe around 73, 74 if you get much below that level. I think as long as these 2 stocks stay, in this uptrend and we continue to hold those areas of support, then I would be okay with ITA. And it is, these are groups that are improving. So if you wanted, to stay away from growth, if you wanted to stay away from, the high flying technology area, and you really would like to concentrate or maybe just have a hedge, something that's outside, this probably makes some sense. Now I'm going to take 1 second here and I'm going to show you this ETF analyzer because I think this is really cool. And by the way, all of our members at Earnings Beats, even trial members, you could be on a 30-day free trial. And what's a no-cost trial? Trials, you have to pay $7, but we refund it to you within a week. So technically, it's a free trial for 30 days. If you're a free trial, you can download this spreadsheet. So if you haven't tried our service, it'd be pretty awesome to do so. All right, so why is this? Oh, okay. So let's straighten this out. So here's ITA. So I've got this tab, top 10 holdings. We just updated our strong ETF chart list. So what we do is usually every month. Now I was kind of waiting. This one took probably closer to 2 months to get out to everybody because I was kind of waiting to watch to see this rotation that was taking place in the market. I thought a month ago it was probably a little soon to really, I wanted to get closer to earnings to see what Wall Street was doing. Anyhow, we just updated this. And on here, if you go across, there'll be 53 ETFs that are on this list. And here are the top 10 holdings. So all the way over, to there. And essentially the way we come up with these is we run a scan at stock charts looking for relative strength winners. So higher scooter scores, stock charts technical rank, SCTR, which is a relative strength measure. And when we do that, we weed out the juiced ETFs, leveraged ETFs 2 times, 3 times. We get rid of all those. We get rid of any inverse ETFs, those types of things. We ignore international. I'm not going to try to be an expert in, investing in Russia. I don't know anything about Russia. And, it also brings in, when you invest in ETFs outside the US, there's a component of currency that you have to be aware of, because that's going to impact your results. So I just focus on what we do at Earnings Beach, which is essentially US equities. And so when we run this scan, we take all that into account. We also have a volume filter. We don't want to buy an ETF that only trades 2,000 shares a day. Now, technically, ETFs will follow the basket of stocks that they own. So the volume shouldn't be as much of a factor, but low volume could result in maybe wider spreads. And I feel more comfortable investing in ETFs that are a little more heavily traded. So normally we're looking for at least 100 to 200,000 shares a day on average. Anyway, here is the ITA, and this is the top 10 holdings. You're going to see this for every one of the 53 ETFs that are on this list. Now, the real cool part is the selection summary. So here, every one of these 53 ETFs on here, you'll see the name, you'll see the top 10 holdings. So here's the percentage. So you can take one glance down this list and see which stocks are highly diversified and which ones aren't. So if you've got a top 10 that represents 79% of the ETF, you better go look at those holdings and like those holdings, because if you don't, you're investing in individual stocks. Some folks say, well, I don't want to invest in individual stocks. I want to invest in ETFs. Well, ETFs invest in individual stocks. So technically you're investing in individual stocks. It's just someone else is picking them for you. But if you look at some of these others, like you get the S&P mid-cap ETF, the top 10 holdings, this is a widely diversified ETF. Top 10 holdings in total are only 7%. Imagine how many stocks are in that ETF. Well, if it's a mid-cap 400, I can tell you how many are in there, 400. That was a brilliant deduction. But I mean, just take a look. And, when we did our selection last quarter, I had someone write in, we had 7 ETFs, and someone wrote in and said, well, these, you're not diversified enough for me. You only have 7 ETFs. It doesn't matter how many ETFs you own. It depends on how many stocks you own within those ETFs. And trust me, if you've got 7 ETFs, chances are, now you might thematically be looking at certain areas like growth or like technology, and you may be skewing things a certain way and you're not diversified in that fashion. But 7, you can be widely diversified among the various 11 sectors with 7 ETFs. Look, so the rest of this is for each one of these ETFs, we show what the percentage is by sector. So whether an ETF is diversified among sectors. Now, here's the beauty. You can go in and say, well, this Van Eck Vectors income fund looks pretty good. I'm going to put 10% in there. And then let's see, here's a regional banks. Oh, banks have been hot. Let me put 20% in banks. I'm high on banks. I better get, mid caps and do a little, maneuvering there, make sure I'm invested in mid caps and spread out. So let me do 20% there. And then you might say home construction. That's been a good group, and rates are still relatively low historically. Let me put 10% in there. And then you come down and, well, that's mid cap 400 again. Let's see. Schwab's got, here's a dividend. Schwab, let's say, 30% in there. Okay, there we go. There's my investments. Well, I look up here and it says error. 90%. Oh, okay. When you add up the allocation, you only put in 90%. So you haven't fully allocated at this point. So you need to put 10% somewhere else. Let's just go with this Schwab fundamental large cap, 10%. There you go. Now it says no error. So now I know that I'm right. So we've got this built-in feature to make sure that you are investing 100%. Now you might decide that I want 80% invested in stocks and 20% in cash. Just treat this 100% as the 80% that you're investing, if you know what I mean. Now here's the beauty of this. Once you pick your funds, you can come up here. Here's what the S&P 500 is allocated in percentages by individual industry group or sector, I mean. And then this is what you've just picked. Now, you might think you just put together the best portfolio ever, but look at what you just overweighted, financials. 42% of what you just invested is in financials. Now, maybe you love financials and maybe that's what you want to do. But this, by going through this process, you know what you own. And that's our mantra at Earnings Beats. Know what you own. ETFs, it's so easy to invest in ETFs and have no clue what the heck you're doing. Well, I heard this one at the water cooler. It was up 60% last year. I'm going to put 25% of my money into this ETF. Don't do it that way. You got a lot of money if you're investing. Make sure you're protecting it. You're comfortable with your strategy. And this is the best way that I've ever seen to do it. We lay out this, I like to put a little bit more into technology personally because I'm very bullish. And during secular bull market advances, technology historically is the best performing area. So the S&P is widely diversified and has 24% in technology. I'd be okay if I had 30 or 35% in technology. Consumer discretionary, I'd be okay with 15, 20%. Actually, maybe even more than that. Maybe I overweight consumer discretionary more than technology. There's a tremendous amount of growth opportunity, I think, in that area. But my point here is you can look across the board when you put your ETFs together and decide whether or not this is an allocation you're comfortable with. Now, the other feature, and again, I'm going to talk a lot more about this later this afternoon. So mark your calendar, 4:30. You can come to our website at earningsbeats.com and there will be an opportunity just to sign right into the room. Okay. So you don't need to be a member for this event. But there's an opportunity. If you wanted to add some ETFs, let's say it's not on the list and you say, hey, I really want to, there are 2 ETFs out there that I'm really interested in. It's not on your list because it didn't meet your criteria, but I want to add it and I want it to be part of my, well, add the ticker, add your name, whatever, put in your percentage, how much you want to invest in it, and then come down here and break down. And you can get this information on Yahoo. You can get it from Fidelity. There's a lot of different places you can get the sector allocations, but go in and enter your own and then put your percentage in and it'll still calculate. Excuse me. So this is a pretty cool feature. And I just wanted to share it with those of you who maybe are new to Earnings Beats, or maybe have been listening to me and didn't even realize we offered it. I get some of those emails every once in a while saying, oh, I didn't know you all even looked at ETFs, but that is a good part of what we do at Earnings Beats as well. We do look at that. All right. Now I mentioned the consumer discretionary. I know the market's just opened, so we'll take a look at that, wrap up and look at the indices in just a minute. But one thing I wanted to do was just show you a group that is breaking out. Before I show you the actual chart, I want to show you the seasonality chart. This is on clothing and accessories. And so if we go back the last 20 years, clothing and accessories, you can see February, March, and especially April. Look at that average return in April, 4.4%. Average. It's not, that's not the best that is done. That's the average over 20 years. And you look across the bottom here, Nothing else is even close. Hold on one second. All right. So 4.4% is pretty good average over 20 years for 1 month. I mean, if you multiply that times 12, you'd come up with about 52%. That would be your annualized return based on April's performance. So keep that in mind. We're in a pretty good month. And take it one step further here and compare the performance to the S&P 500. And if you draw that back 20 years, you can see that clothing and accessories outperforms the S&P 500 by more than 2 percentage points on average during the month of April. And the only other month that's more than 1% is February. So you can see that's pretty strong. Now let's take a look at what's going on in the chart, because I mentioned this at the open. We were breaking out. Look at the breakout here above this top. So I see a move up, equal highs coming across, rising lows. I think we've got an ascending triangle breakout, which is very bullish. So any kind of a pullback here, I would be looking at clothing and accessory stocks. So I thought what I would do, I know we're running late here and running out of time, but I think this is pretty important. I would go into dashboard, and using our tools that we have on our research platform at Earnings Beats, what I would do is go in, I'd do a new scan. I'd get rid of all the volume, because we filter out stocks based on volume when we put our chart list together. But what you can do is go down here to sectors and industries, go under the cyclicals area, clothing and accessories, add that, and then come over to your chart list. Just in the essence of saving some time here, I'm just going to pull up our strong earnings chart list number 1 and our strong earnings chart list number 2. These are companies that have beaten Wall Street estimates as to both revenue and earnings per share in their latest quarter, and also are liquid. So we look at volume to make sure that these groups, or these stocks, are liquid stocks, and they also look good technically. And I'm just trying to get this set up. So essentially what I want to do is I want to go in and pull all clothing and accessory stocks that, any stock that's in that group and also is in one of these 2 earnings reports chart lists. So this is telling me that I'm not only looking at clothing and accessory stocks, but I want to pull the ones that I know have beaten Wall Street estimates. And if I run this scan, you will see, and we can put it in scooter order. Here are the 8 stocks, and these are in scooter order, relative strength order. And you can just quickly go in and take a look to see. I can tell you Tapestry is one of our stocks in our portfolios, and you can see he's having another pretty good day. Bounced beautifully off the 50-day moving average, threatening a breakout. But this is the type of stock that should benefit from a strengthening clothing and accessories group. So the research that we do, I think, can lead you very quickly into some great stocks. All right, I tell you what, that will be one of our three you must see. So let me get 2 others. Let's look at the top one there, Funko. Beautiful move to the upside. I would personally wait on a 20-day test, but look at the volume coming in on the move to the upside. Funko clearly is one of the top performers. I would just simply want to see a little bit of a pullback. I think it's a short-term risk to jump in at current price. And then the other one I'm going to pull up is KTB, because this one I think is one that I mentioned on your Daily 5, which is a show over at stockcharts.com. And I don't remember when it was. I think it was I don't remember if it was in March or February that I mentioned this stock as being one of my favorites. And you can see the stock making a breakout. Really, really strong looking stock. And if we pull this up in a relative chart basis, this is where you'll see, look at the relative strength of KTB relative to clothing and accessories. So it is a leading stock in a group that's just making a big breakout. So that's the type of analysis we like to do at Earnings Beats with individual stocks. But later today, we're going to be doing that ETF sneak preview. So if you liked what you saw you'll get a lot more of that in our strategies and some of the themes we're looking at and so forth, and how to take advantage of all that Stock Charts provides us on their platform and everything that we provide on our platform. I think it's pretty powerful. All right, let's take a quick look at the market and wrap this thing up here. Dow down 27, S&P down 1, Nasdaq down 31, seeing a little bit of profit taking. We do see maybe it's a turn because small caps and mid caps have been underperforming of late. Maybe they start to outperform again. That would be nice. VIX up today, almost 5%, but it is still considerably lower. And I'm okay with that. I like to see the VIX pick up. And I like to see the nervousness in the market because usually Wall Street will fight that off. Anyhow, everybody have a great day today. We'll be back tomorrow over at Stock Charts TV for your next Trading Places live show. It'll start at 9 a.m. Eastern, and hope to see you over there. Have a great day, everybody. Happy trading.